Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dmitry Pogomonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with a disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do or just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen real quick. If you guys are joining us for the first time, we do this show really to answer any questions you have on Market Chameleon tools, data, analytics, strategies. If you want to come on a show and talk about something unusual you've seen, you could ask those questions two ways. One is put the question on a live chat on YouTube. Will's watching it. He'll read them back to me. You could also come on a show live. We provide a link to Zoom. If you click on that link and go over to Zoom, there's a button, raise your hand. Click on that button. You don't have to turn on your video camera, but once we let you in, everybody could hear you. You could ask your question live and direct. Now, while we're waiting for questions to come in, what we'll do is start out with the pre-market report, see what's trading in pre-market hours. I'll navigate to maybe a couple other reports, see if we could get some market insights. I have some questions coming in through the weekend, so I could default to some of those questions, discuss those. But if questions come in, Will let me know. I'll stop and take those first.
Perfect.
All right. So pre-market report. These are stocks trading in the pre-market hours. We have our most active list, our biggest percentage gainers, biggest percentage decliners. Here I see 62 stocks made our percentage gainers list, 69 on the percentage decliners. It's pretty even from that perspective. What we want to do next is try to narrow this list down. As you could see, this list includes any security that will trade on the major U.S. exchanges, which can include small cap stocks, ETFs, leverage products, closed-end funds, preferreds, and so on. Let's narrow this list down to only S&P 500 companies, see what's going on there. And to do that, we're going to use a filter here in ETF. When you click on it, drop it down, you can see there is a list of ETFs to select from. The first one is SPY, which is the S&P 500 ETF. And when you select that, the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And you can see here, 6 stocks made our percentage gainers list, 9 on the decliners. From this perspective, slightly bearish bias at the open. I see a couple stocks here. The bank stocks are right now reporting earnings. I see Goldman here up and down 2.7%. When you come over here to this column on alerts, you get an E indicator or an N. An E is indicating that it just reported earnings. So it could be reacting to that earnings event. The N is indicating that we're picking up news. And if you hover over it, you can see the headline news on that stock. If you click on that headline, it'll take you to the news article. Okay. So right now, pretty, a little, not a big list, a little bit bearish bias at the open. And we are coming up, I think what we had a pretty decent rally so far in the last week or two. So far kind of holding it there. If there are no questions, Will, what I might do is default to some questions I gotten over the weekend.
All right, perfect.
All right, I'm trying to do it from memory here. One of the questions was regarding theoretical values. So if we go here to trade ideas, you can see there are trading cards here, looking at different types of strategies, right? Iron condor, you can see long straddle, long call. If you drop it down, you could select from other strategies here. So, bull call spread, and this will give you some trade cards that we are screening. These are automated screens that we set up using some of our preset filters. And once they hit those conditions, it will show up here. So bear call spread, switch it to a bear call spread, get other trade ideas. And they're coming from these screeners. So you could go in there and you could set your own parameters, your own requirements, your own conditions. These are starting points of trade ideas, and the basis of them is a theoretical edge. Okay, so you can see here's a bear call spread, which is a bearish trade, right? It's bearish trade. There's a bull call spread, which is a bullish trade. And what it does is it scans the markets and looks at different combinations of options. And when it prices it, it looks into it, it goes back into the historical database and sees how is the market price today versus a theoretical value based on how the stock tended to move historically. Okay. And it comes up with a value. So you get a theoretical value versus a market price. And then you can compare the difference, right? And how frequently did based on how the stock performed historically, how frequently would have this resulted in a profit? And we talked about theoretical values, market price a lot of videos, but the question was, well, can I take these, right? Take these trades and capture them and see how they ended up at expiration, right? Did they result in a win or a loss, right? In a profit or a non-profit. And I wanted to kind of maybe come back and then explain it better, because I think that the way that question is posed does not make it clear that you understand the theoretical edge, okay? Or maybe not even at all, if your assumption is that, well, I'm just going to take this trade and I'm going to wait till the end, and based on the end result, that's how I'm going to judge it. And I'm going to explain to you why. You have to look at it from this moment in time, okay? Because it's not predicting. This is not a prediction if the stock will go up or down. Not at all, 0%. You got to get that out of your mind, right? That's not what this is about. As you could see, there's a bull call spread, which is the stock going up. There's a bear call spread, right? That's the stock going down. So it's not a prediction of where the stock is going to end up at expiration. It's not any kind of prediction, okay? It's looking for a theoretical edge, or again, something extra, right? A little bit of extra for taking on that risk. So let me show you an example. It's important to understand that, because if you don't understand it, then you're not even using it correctly, and then there's no point of you using this tool, right? If you don't understand it. So let's just go over an example. Look, I could give you let's start out with a very simple example, then maybe I'll get it, I'll start building it up. But this is the most simple example I could show you for just to answer this question. Look, I could give you a very simple game, right? I could give you a coin, right? Here's a coin. And the coin has a heads, right? And a tails. That's it. This is a very simple one. Obviously, a stock is much more complicated, but let's just say you have a heads or tails, and you say, Dimitri, okay, so where's the edge, right? We look at the variables, right? We look at all the variables, known variables, right? But this one is going to be easy because it's only a heads or tails. And let's say we calculate that the edge is to bet on tails. Okay, that's where the edge is. Edge is tails. You don't ask why is the edge tails, right? What you're saying, this is what people are doing. They're saying, okay, I'm going to see if the outcome is heads or tails, and based on that outcome, I'm going to make a decision if you're right. Okay, so let's say heads comes up. So let's say this is heads. You didn't ask why is there an edge. At that moment, remember, we're not looking at the prediction of heads or tails. We're saying there's an edge to trade on tails. And you say, well, then your analysis was wrong. Your analysis was completely wrong because the outcome was heads and you said the edge was tails. And that's it. All right. So now let me show you. Now, and this is happening. I could see this happening. And the smarter ones will come back and say, okay, heads did come now, but Dimitri, why did you think it was tails, right? Like, I understand this outcome was not predictable, but why did you think it was tails? And that's the question you should be asking. Why? I know that this was the outcome afterwards, but if you're not asking this, why did you think it was tails, and you're going to judge it by what the outcome was, then you shouldn't be using this tool. Okay, I'm going to tell you right now. Then find some other tool. I don't know. I can't, but it's not the right tool for you. But the questions will, Dimitri, why did you think it was tails? Right? And the answer would be something like this. Look, we're looking at this coin, and we know there's only two outcomes, heads or tails. That's the only outcomes that they're possible, right? And the probability is 50-50. So there's no real edge in that. And we don't know if a heads or tails to come out. We have no idea once somebody spends if there'll be a heads or tails. But the other information we looked at was the payout. And before they spun, they said, okay, if heads comes out, you pay me $1, right? And if tails comes out, we pay you $2.50 or whatever, $2.50. Maybe it's $1.01. And based on that information, we said that there's more edge betting on the tails than heads. We have no idea. Remember, we have no idea what the outcome is, and we're not even trying to predict the outcome. Right? That's not what we're trying to do. When you go to the casino, do you ever see the dealer trying to predict the outcome? He lets you do the betting, right? So the point is that at this moment, you should be asking, at this moment, why did you think? I understand, there's risk and we don't know what's going to happen. But at this moment in time, was your model reasonable, right? This moment in time before the outcome, was that your model reasonable to estimate that there was an edge in a particular bet, right? When you start asking those types of questions, then you're getting into then you're kind of starting to understand it better. All right. So you could see here, if you're over here and not over here, then you're not even making a correct valuation. And, then because we're not trying to predict the outcome, we're trying to see where do you get a little bit extra? You could bet on heads or tails or whatever, but where are you getting a little bit extra for the risk? Okay. So let me give you another example here. I'm going to take this out of here. So that's heads or tail. But we know that that's if you're spinning it one time, right? So that's the simplest example. But stock prices are moving around between now and expiration. Implied volatilities are moving around between now and expiration. There are different news and events coming out between now and expiration, which means that it's dynamic. There's no way to say that this is going to be the edge between now and expiration. It's not going to change. Okay, so let's look at another example. So let's say these are cards, right? Let's say these are playing cards. I'm gonna just let's see, copy paste here. So wait, what's happening here? Okay, so let's say there are two people playing poker, right? And you have two cards flipped over, and the first guy has a 2 and a 3, right? And the next guy has a 3 and a 3. So that's all you know right now, right? And you know there's going to be, more cards are coming, right? This game's not over. More cards are coming. There are going to be 5 more cards for poker, right? You're playing poker. But so far, you don't know what those cards are. But this is the information you have. So based on this information, you calculate the odds. And not knowing what the other cards are, this one, right? This one over here has an advantage, right? He's got a pair. The other guy doesn't have a pair. He has a 2 and a 3, right? So right now, this guy has the advantage. And that's all the information you know, right? So if you had to make a bet, right, then this would be the better one. Bet on this guy, not on A, on B. But remember, I said that stocks, they're dynamic. These odds are not going to remain the same as more information is revealed. So let's say now we get 2 more cards flipped out, right? And let's say both of them are a 2 and a 2. So what just happened? The odds just flipped from, player, let's say player A to player B, right? Now the odds just flipped. Now player A has 3 2s and player B has 2 3s and 2 2s, right? But player A is better. He has 3 2s, right? So what's going on is that as you're moving and getting more information, that's getting plugged in, and now the odds at this moment favor player A, right? So player A, right? Am I right? Well, 3 2s beats 2 pairs, right? Yeah. So what's going on is, just like in the stock market, it's not fixed from this point all the way to expiration. It's changing as new information comes in, right? So you could only see it at this moment in time. So now look at it. I know more cards are coming, right? But I have to look at it at this moment in time. What is my information? And based on that information, where is the edge, right? Because I have no idea what the next cards are going to be. Nobody knows, right? Nobody should know if it's a fair game. So not knowing that, and I have to make a decision, it looks to me like player A has the advantage at this point. Well, let's say 2 more cards come in. All right. Well, what about, what if it's a 3? Well, that will shift it back down to player B, right? More information's coming out and the odds are changing, right? So I'm giving you simple examples, right? The models and when we're building financial models, with financial securities, you don't even have fixed results like this, right? There's so many cards because everything's dynamic. There are unknowns of unknowns, right? So anything could happen, going forward. Who knows? There could be, China could close again, or the war could be over in Russia, or there could be another war somewhere else in the world. And those things that are unpredictable can randomly happen, and we don't know, until it happens. We could just look at the information that's in front of us, the available information, and say, not knowing what's going to happen tomorrow, the day after, or the next minute, or even the next second or the end of the day, given the information we're looking at, and given our analysis of that information, where do we think the current edge is? And that's what we're trying to do. So when I say we don't know, try to think of it as estimating a insurance policy. Well, there's no way for you to know the person you're selling health insurance will get sick or stay healthy, or hopefully not, but something tragic could happen, or an accident. There's no way of you knowing that for sure when you write an insurance policy. So you have to come up with some kind of model to estimate what do you think the odds are, and based on those odds, what do you think the cost of insuring that person will be? And then you're creating that model. So you could see that there's so many different variables that could go into that model. And then here you kind of know what can go to your model, because you know all the cards and possible combinations, right? So sorry. And here, you know the cards, how many decks they use, what's possible. So you could kind of calculate the probabilities. But when we're talking about building financial models, it's not like that, because there is an information that you're not, that you may not even contemplate that could happen, like a war or something like that. There's a lot of different information that could go into your model. So it depends on what you're putting into your model, how much weight you're giving. So there's no perfect probability or model. You're using a certain model, sticking to a methodology to say, here's, based on this information, this data, these are the probabilities. Okay. So when we look at that, right, when we look at these, remember, it's a moment in time, right? It's something moment in time, given a certain data set of information where, you could go in here and read about it, like how many years of information and all this that you're using. And it's calculating not a prediction of where SPY is going to be, right? That's not what it is. That's not a prediction of, just like here, remember, this is not a prediction of the next cards, right? Like when we started from over here and calculated, how do I get rid of this? When we calculated the initial odds, we were not predicting what the next cards will be. What we're saying is, based on what we're seeing right now and not knowing what the cards will be, the odds favor B. Okay. Hopefully that makes, wait, did I pause my screen sharing somehow? Well,
no, it looks fine.
Okay. All right. So it says here your screen sharing is paused. Okay. So you're seeing me flip Looks fine. All right.
I'm seeing you.
The trade cards.
Yeah, the trade cards. Actually, no.
Okay.
I'm seeing.
Okay,
I'm still seeing the description. Your notepad.
Wait, resume share. Do you see it now?
Yeah, now I see it.
Okay, so let me just go back here. When we start from here, right? When we start from here and we're looking at this information, and we're calculating, well, who right now has the advantage, A or B? We're not trying. We cannot predict what the next cards will be, right? That's not what we're trying to do. What we're saying is, given what we're seeing, B has an advantage, right? But we're not saying, well, we predict the next cards will be blah, blah, blah. No, that's not what we're doing, and the outcome could be anything. A could win, right? It could still win because there's still lots of cards that are between now and the end of the game, to be flipped over. And similarly, when we look at this, right, the trade card is not trying to predict anything of SPY's price in the future. It's saying that given right now the price and given the option prices, and the strategy in this case, if we compare that, to data, just like we did, with insurance policies and so forth, there's a theoretical edge to this side. Okay, so that's the point that I was trying to make.
All right,
hopefully
perfect.
Here's it up, because that was the question that came through.
All right. Well, we had a couple questions about rebalancing of ETFs. I sent, Area had one, and then Rob had a question on top of it, and he said he'll send an email, or he had sent an email previously, and maybe he'll follow up with that email. Maybe we'll hit that tomorrow. Great job, buddy.
All right. Thanks, everyone, for joining. Everyone, stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Great job, D.